Hi guys, thank you for coming online on a POE day. So today it will be a slightly extended session. We will be having another class on the 28th, and then 6th and 14th you won't have classes. Sorry, I think 7th and the 14th you won't have classes, right? So we meet 2 days from today, and then in about 3 weeks. So from that point onwards, we'll have about less than a month for you all to prepare for your exam, I think. Yeah. Right. So we want to fixed income securities. Do you all have any questions from where we stopped last week? Any questions? Okay, so if there are no questions, we can continue. We did the basic introduction to bonds. We discussed about yield, discounts. And so what you should remember is a discount is based on the face value, whereas yield is basically the return that you get on your investment, right? Okay, so bond price sensitivity. Now, we initially learned that bond prices are inversely related to interest rates or yields. So higher the interest rate, lower the bond price. Okay. Now, if interest rates move by 1%, right, do all bonds change by the same percentage? You got the question? Let's say there is a negative relationship between bond price and interest rates. So if interest rates go up, bond prices comes down. And if interest rates go down, bond prices go up. So the point is, now if interest rates change by 1%, let's say interest rates go up by 1%, do all bonds change by 1%? Because there are so many bonds in the market, right? So many bonds issued for various tenors. Some are short term, might be maturing next month. Now these are all long term originally when they were issued, but there are maturities that come up regularly. Every month or every 2 weeks, there is a maturity coming up. Right? And central bank had an auction, bond auction even last week. Now, so there are bonds maturing every month, so which means there are bonds maturing in 2021, 22, 23, 24, 25, 2045 also. Right. So the question is now, if interest rates increase by 1%, will all bonds come down by the same percentage? Right? Will the 2022 bond drop by X%? And will the 2045 bond also drop by X%? Is that how it happens? That's not the case. Because various bonds will have various sensitivities. That is what is meant by bond price sensitivity. Now let's see what it means. Right. Okay, so to explain this point further, I will use an analogy. Something like this. This is supposed to mean a coconut tree. Right. And next to the coconut tree, let's assume there is grass. Now, out of these two, obviously the coconut tree is taller. It is short. Right. So if there is a strong wind, there is wind that is coming. There is a wind blowing. The coconut tree obviously moves a lot more than grass. Right? So which means the coconut tree is more sensitive than grass. Right? It moves more. Understood? Whereas glass moves little. So the difference is the height. The tall height is the more sensitive it becomes. Now, similarly, if wind was interest rates, right, and the height of the tree is what we call duration. Duration is a technical term in this case. Right? The height of the tree is duration. Longer the duration, higher the sensitivity to interest rates. Right? That is how it works generally. Longer the duration, higher the sensitivity to interest rates. Okay. So the sensitivity to interest rate changes is measured by what is called duration. So duration is a measure of interest rate sensitivity of a bond. Now the next area is focused on duration. How do you measure the interest rate sensitivity of a bond? Right. So in this analysis, we have analyzed the price yield relationship of various types of bonds. Coupons going from 0%, 5% to 10%, and maturity is going up to from 5 to 20 years. Then yields, we kept changing yields from 7% either way. Okay, actually from 10%, 3% down and 3% up. Right. Now, what we need to find is what determines duration. Okay. Duration or the interest rate sensitivity determined by what? What factors? Now, the conclusion that we arrive at will be that duration depends on the coupon as well as the maturity of a bond. Coupon and the maturity of a bond. The duration depends mainly on these two factors. It also depends on interest rates. But the main two factors are the coupons and the maturity of a bond. Okay. Now, how it works is longer the maturity, longer the duration. Right? Longer the maturity, longer the duration. Also, lower the coupon, longer the duration. Low coupon bonds will have longer duration. Right. Now, to explain that point, you can use this table. So the base case interest rates in this case 10%, right? So when the yield is 10%, a bond with a coupon of 10% will have a price of 100. 5% coupon. Remember, in this case, we are analyzing 5-year maturities, right? 5-year maturities. We have 3 different coupon rates: 10%, 5%, and 5%, 0%. So 10% coupon, 10% yield, 10% yield, 10% coupon, 5-year bond will have a price of 100. 10% yield, 5% coupon will go at a discount of 81.05, and a 0 coupon bond will go at 62.09, right? That's a 5-year bond. Now, when interest rates drop, the price of this bond keeps increasing, if you notice, right? When you go from 10% all the way down to 7%, the price gradually increases. Whereas that is the case with all the bonds. Whatever the yield you use, as you keep lowering yield, the price keeps increasing. Whereas as you keep increasing yield, the price keeps dropping. Right? So that is consistent with the bond price and yield relationship. High the price, lower the price, lower the yield, high the price, and higher the yield, lower the price. Also, if you move on to the next area, the next column, you will see 20-year bonds being analyzed with coupons of 10%, 5%, and 0%, right? So 10% yield, 10% coupon, the price is 100, and as the coupon keeps dropping, the price also increases. 20-year 0 coupon bond is going at 14.86. And as you reduce the yield, the price again keeps increasing. And as the yield keeps going up, the price will drop. All right, so now analyzing the sensitivity of these, you will see that what we discussed, as we discussed earlier, as yield keeps increasing, the price keeps dropping. But Now just have a look at the 10% coupon 5-year, right? 10% coupon 5-year and 20-year. We discussed initially that longer duration bonds will be more sensitive to interest rate changes. So as the 10% coupon bond, right, at a yield of 10%, reduces if the yield drops from 10 to 7%, the price changes by 12%. Whereas the 20-year bond, that is in 5 years, now the 20-year bond, the price will change by 31%, massive. Yeah. And likewise, when the price of on the 5-year 10% coupon increases from 10% to 13%, the price will drop by 10.5%. Whereas the 20-year bond, the price will drop by 21%, massive. Okay. So now, if you notice, the coupons are the same, both are 10%. The only difference is in the maturity, right? So longer maturity bonds are more sensitive. The same applies even if you go to 5% or 0% coupon, right? Longer maturity bonds will have a higher sensitivity. The other thing to observe is what happens if the maturity is the same, let's say 5 years, and the coupon keeps dropping, right? So at a 5-year maturity, 10% coupon you will see is less sensitive than the 5% coupon, right? So lower the coupon, higher the sensitivity. See, the 0 coupon bond is very much sensitive, 14% against the 10% coupons, 12%. Likewise, even if prices go up, the 10% coupon will drop less, whereas the 0% coupon will drop by much larger amount. Okay, so the conclusion we can come is that the duration of a bond is inversely related to the maturity. Sorry, it's directly related to the maturity. That means longer the duration, longer the maturity, longer the duration, and inversely related to the coupon. Right, lower coupon, longer duration. Okay, I hope that was clear. If you didn't understand that, the easiest way to remember is longer duration comes with long maturity and low coupon. It's all L. So it's the triple L principle. This is what you need to remember, right? Triple L. You need to remember the triple L concept. Okay. Only thing when you go for the exam, you should know what the triple L stands for, right? Long duration, long maturity, low coupon. Any questions up to now? Right. So that is what this table tells us. Longer duration bonds are more sensitive, whereas lower coupon bonds are again more sensitive. Price sensitivity, bond price sensitivity, the price sensitivity is not uniform for all bonds and depends upon the bond's maturity, right? Positively related longer maturity bonds have longer duration. Bond coupon inversely related, because low coupon is more sensitive than high coupon. Yield to maturity, again inversely related, lower yield at a low yield, bonds are more sensitive than high yields. Right, so it's easy again to remember, because if you talk about yields, there is an inverse relationship, because coupon and yields are both interest rates. So if you talk about interest rates, there is always an inverse relationship, and maturity only there is positive relationship. Measure of a bond price sensitivity needs to take account of all cash flows, right? Bond price sensitivity needs to take account of all cash flows and reinvestment risk. Now, very important thing, reinvestment is when you take a bond's cash flow, you have coupon as well as the face value which you receive at maturity, right? So when you look at reinvestment, all of the cash flows that you get, whether it's coupon or the maturity amount, you need to reinvest. Okay, now especially the coupons. Whenever you get coupon, bond price calculation assumes that you're reinvesting at the same yield. Okay, that's a basic assumption. If you keep reinvesting at the same yield, which may not be the case. Measure of a bond price sensitivity needs to take account all cash flows and reinvestment risk. Duration is the price volatility of a bond, or the price sensitivity of a bond. Duration measures the effect of measures the effective maturity of a bond. It measures the weighted average life of all cash flows. Weights are the present value of cash flows. Fundamental measure of it's a fundamental measure of interest rate risk, right? Duration directly related to price sensitivity. So this is how it's calculated. And this equation you better remember. It's easy if you could remember this. So duration provides an ordinal scale of risk. That means a measurable quantity of risk, right? Duration becomes measurable. Factors affecting duration, like what we discussed earlier. Obviously, the maturity. Duration increases with maturity. Long duration is associated with long maturity. Right? So long maturity bonds have long duration. Coupon level, low coupon, duration decreases for increasing coupon. So low coupon have long duration. Yield, duration decreases as yields increase. So low yield, long duration. That also is another L. So these are the three main L's. In addition, you can also use yield. Low yield, long duration. Frequency, duration decreases as coupon frequency increases. Right? Duration decreases as coupon frequency increases. Also frequency, low frequency, long duration. It's L. Any way you look at it, it is L. These are the main two factors, maturity and coupon. In addition, yield and frequency of coupons, right? So that means that is why a lower coupon bond, right, for a zero coupon bond, duration for a zero coupon bond, duration is equal to maturity. Otherwise, duration is generally less than or equal to maturity. duration should be either less than or equal to maturity. For zero coupon bonds, the duration is equal to maturity. Higher the duration, greater the interest rate sensitivity, right? So higher the duration, greater the interest rate sensitivity. Remember this example, it's easy to remember. Okay, so if you look at what is happening around you, very simple, no? It's a mathematical world. We live in a mathematical world. Everything is mathematical. At higher frequency, higher interest rates, long duration, shall say, higher sensitivity. Higher the duration, the greater the interest rate sensitivity. Duration says something about bond price volatility. Right. So let's try this example on duration.
Excuse me, sir. Before we move on with questions, can you just explain the difference between the duration and the maturity?
Duration and maturity.
Yeah.
Yeah, sure. So let's take a 2-year bond, right? 2-year bond with a coupon of 10%. 10% coupon. Right now, this means every year you will get payments of 10. If you plot your cash flows, this will be your cash flows. Now, if you are investing in this bond at a yield of, say, 8%, right? You will get a certain price for this bond. So you calculate the present value and the price, right? Now let's assume the price is 105. Now my question is, let's say I got the calculations right. Can this price be 105 or not? That was a good question by the way, Sonali, right? Thank you for the question. My question is now, if you are given something like this, you're asked to the question asks you not to calculate the price, but just to say whether the price can be 105 or not. What are your thoughts? Let's assume all the calculations are correct. Can the price be 105 or can it not be 105? Okay, could I have said the price is 98? Could I have got a price of 98 for this? What do you all think? Could we have got a price of 98? Yeah. Can we get a price of 98? Without doing any calculations, can you all tell me? Can the price be 98 or not? If you understood what we did so far, you should be able to make a comment. Can we end up with a price of 98? Yield is 8%, coupon 10. Right. Can we get a price of 98? Face value 100. And the answer is we can't get a price of 98. Why? Because in this case, the yield is less than the coupon, so it has to trade at a premium. Right? Meaning this one should trade at a price which is higher than 100. So price of 105 is reasonable. Should get something like that. Now forget about this. Okay, so the question is, what is the difference between duration and maturity? A very simple question. Now, what is the maturity of this bond? Maturity of this bond? Yes, Jan, you're quite right. Your answer is correct. What is the maturity of this bond? Maturity?
2 years.
2 years. Very good. So this bond has a maturity of 2 years. Very clear. Right. Now,
Yeah.
for a minute, let's forget about bonds. Can you all remember we did something called payback? Payback. The concept of payback, how long it takes to recover your investment. Can you all remember that? How long it takes to recover an investment? Payback? Can't remember. Cumulative cash flow. Right, so cumulative cash flows are minus 100, minus 80, minus 30, and 40. Right, so the payback period of this project is 2 years. Two years, 3/7. 3/7 years, which means within 3/7 years, you recover your cash flows. Right. Whereas the project duration is, what is the duration of this project? Sorry, not the duration. The maturity of this project is 3 years. This project runs for 3 years. Whereas the payback is 3/7. Right. So this is the payback. This is the maturity of the project. Now duration and maturity are also similar. This is the maturity of the bond, 2 years. Duration means how long it takes to recover your investment. It's something like payback, similar to payback. Clear? Sonali, that is the difference between maturity and duration.
Yeah, sir. Yeah, thank you very much.
Right. Good question. Okay. Shall we move on to the question? Says a 4-year 10% coupon bond is selling at 100. So it's 4-year 10% coupon bond selling at 100. So if 100 is the face value, that means face value is equal to the bond price. If that is the case, yield should be equal to the coupon. Right? Yield should be equal to coupon. Usually the price of 100. Now the next thing is to calculate the duration of this bond. Divided by the price of this bond. Right? So we know the price. We now need to calculate percent value into time. Time in this we have put as n. I will put it as n. How else I change this? This as t. So present value 9.091 into t is 1. 9.091. And present value 8.264. T is 2. This times 2 is the duration comes as 349.4 divided by the price of 100. Right now, in duration terms, this is specifically called Macaulay duration. Dinesh, your question is, can't we find the present value using the formula? What is the difference between the two? What do you mean, the formula and which two, Dinesh? Not very clear.
Hello.
Yeah.
So there's a formula that present value equals to future value equals to present value into 1 plus Rn formula.
Yeah.
Using that, can't we find the present values of each? Other than the considering discounting factor?
Yeah. It's not. No, which you mean the present value formula?
Yes.
This one, right?
Yes. Yes.
Yeah, that is what we have done. See, present value is the future value, right, into 1 plus R to the power n. This is future value into 1 over 1 plus R to the power n, which is the future value into discounting factor. That is what we have done.
All right.
Same
Right.
thing.
Right. Yeah.
Same
Good.
thing.
Okay. So thank you.
Okay, so now this duration is specifically called Macaulay's duration. Macaulay duration or MAC duration. That means the weighted average maturity of a bond. Right, so Macaulay duration measures the weighted average maturity of this bond. Remember the payback period? Right, this is the payback period in terms of in bond terminology. Macaulay duration. How long it takes to recover the 100 that you invest in this bond. It takes you 3.4, almost 3.5 years to recover the price of this bond. Right. Now, the bond price sensitivity in this case is measured by modified duration, what we call modified duration or M duration. I call it duration divided by 1 plus R. So the max duration is 3.49 divided by 1 plus 10%. $3.17. Okay, so Macaulay duration gives the weighted average maturity, whereas modified duration gives the interest rate sensitivity. So if you ask to calculate duration, you can just calculate Macaulay duration, doesn't matter. But the best thing is to calculate modified duration, which gives a result of 3.17 years. Now the next question is, how do you interpret this 3.17? How would you interpret 3.17? What do you all think? How can you interpret 3.17? How would you interpret 3.17? Yeah, how would you interpret this? How would you interpret 3.17? It means, now what does duration mean? The interest rate sensitivity of a bond. In this case, 3.17 means for every 1% change in interest rates or yield, the bond price will change by 3.17%. Every 1% change in yield will result in the bond price changing by 3.17%. Right? So if interest rates go up by 1%, the bond price in this case will change by 3.17%. Okay. Right. Let's do a small change. Let's say this is a zero coupon bond. Zero coupon bond. So that means you don't get coupons in between. And this is the next example. Let's calculate modified duration. This is a zero coupon bond. Zero coupon bond. So you get at maturity 100. Right, so let's calculate modified duration. What is your answer? Price comes to 68.3, which is less than the face value. So this bond is trading at a discount. Remember, zero coupon bonds will always trade at a discount, right? Because the coupon is zero, yield is always higher than zero. They will always trade at a discount. You get a duration of 4. Right. So as we discussed earlier, the duration of a zero coupon bond is equal to maturity. Right. It happens only in the case of zero coupon bonds. Duration equals maturity. Right. So any questions up to now? That's what is given in this question. Conclusion is, for a zero coupon bond, duration is equal to maturity. Let's try the next question. Five-year bond, 5-year 7% coupon bond selling at a yield to maturity of 6%. Right, so coupon is 7, your yield is 6, meaning this will have to be a premium bond. Right, so the price should be more than the face value. 7% coupon. Every year you get a coupon of 7. And so you get a Macaulay duration of 4.4, modified duration of 4.15. Okay. So Macaulay duration means it takes you 4.4 years to recover your investment. Right, which in this case is the price that you pay, 4.21. And modified duration will tell you that for every 1% change in yield, you should expect a price change of 4.15%. Any questions on this? Any questions, or is this clear? All right, so let's move on. Interpretations of duration. Duration is the weighted average maturity of a bond's cash flows, where the percent value of cash flows serve as weights, right? It's what we did. Percent value of each cash flow or the weights. Duration of bond is the term to maturity of its equivalent zero coupon bond. That's a very interesting point, right? If I may ask you a question. based on this example that we just did. Based on this example, right, what is the maturity of a zero coupon bond which has the same interest rate sensitivity? Okay. So understand the question properly. What is the maturity of a zero coupon bond which will have the same interest rate sensitivity? What would be your answer? Did you understand the question? The maturity of the zero coupon bond which would have the same interest rate sensitivity. Okay, so what is your answer? The maturity of a zero coupon bond which will have the same interest rate sensitivity. You can answer that question using what you learned up to now.
$4.4
Very good. Excellent. Yes, you're quite right. Why? See
because
the
it's a
yeah,
zero coupon bond. The maturity equals the duration.
exactly. Yes. The interest rate sensitivity of this bond is 4.15 years, right? It has a Macaulay duration of 4.4. So for a zero coupon bond, the Macaulay duration should be equal to its maturity. Yeah. The answer to my question was, what is the same? The interest, the maturity of a zero coupon bond which has the same interest rate sensitivity. The answer should be 4.4 years. Understood? Okay, so let's move on. Duration is the future point in time at which, on average, an investor will have received half of the original investment in percent value terms. Duration is the balancing point of a bond cash flow stream, where the cash flows are expressed in terms of present values. Right? Yeah. So this is the bond price yield, the price yield relationship of a bond. Right. So if you observe carefully, you will see that this has a convex shape. Right? It's a convex curve. And if you draw a tangent to the curve, you will get the duration of this bond. So let's try these questions. practice questions. Let's try this. First question, 3-year bond, base coupons of 8%, yield to maturity of 10%. Right? So coupon is 8, yield is 10. This bond will be trading at a discount. This bond is trading at a discount. Let's calculate present value into time. So let's try the second question. Okay. So if you all have any clarifications, but get them clarified. Question number 2. An 8-year bond which pays coupons of 9% has a yield to maturity of 10%. So let's calculate duration. Calculation is similar, so let's not waste time on this. You get a duration of 5.97 years. Any questions with question number 2? If there are no questions, let us move on. Duration is a measure of interest rate risk. Right? Very important point. You need to know that duration is a measure of interest rate risk. As we are using it here, refers to the sensitivity of bonds value to changes in interest rates. Right? So remember, duration is a measure of interest rate sensitivity or interest rate risk. Duration is a measure of the bond's price sensitivity of a security to changes in the yield. Specifically, it can be interpreted as an approximation of the percentage change in the security price for a 1% change in yield. Right. So you need to remember this equation also. Duration is the percentage change in price divided by the change in yield. But don't forget the negative sign. Percentage change in price divided by the change in yield. So if you want, this is Macaulay duration, if you want to get modified. Like that. Let's try this. If a bond's yield rises from 7 to 8% and its price falls 5%, you have to calculate duration. So this question seems correct. Yield is going up from 7 to 8%, which means the price has to fall. Right? So if the bond yield has gone from 7 to 8%. That means interest rates or yields have increased by 1%. Price has come down by 5%. So obviously the duration has to be 5. Let's use Macaulay duration. Or you can even use, what is that duration? Price has dropped by 5%. Yield rises from 7 to 8%. Change in yield is 1%. 1 plus previous yield used to be 7%. You will get a duration of 4.67 years. Next one, if a bond has a duration of 5 and the yield increases from 7 to 8%, calculate the approximate percentage change in the bond price. Bond has a duration of 5. Yield increases from 7 to 8%. That means yield is going up. You have to calculate approximate percentage change in bond price. So yield is going up by 1%. The negative sign will remain. Right. Since the yield is going up, obviously the price has to drop. It will drop by 5.35%. Third question. The bond has a duration of 7.2. If yield decreases from 8.3 to 7.9, you have to calculate the approximate percentage change in the bond price. Bond has a duration of 7.2. Yield drops from 8.3 to 7.9. Right, yield is dropping. That means price will have to increase. It is 0.4% negative. 8.3 to 7.9. Bond price will increase by 3.12%. Any questions up to now? Okay, so no questions. Next concept is convexity. Right, now if you look at this duration equation. Okay, so this is like y equals mx. In other words, m is equal to y over x, which is, as we learned in grade 2, a straight line, right? Whereas bond prices have convex shape like this. It's convexity. So it's not 100% correct to calculate the change in bond price as a straight line, right? Because of convexity. Goes like this. Not exactly a straight line. It's not correct to calculate it as a straight line. Because if it was a straight line, it should have been something like that. Not the case. Yeah. Which is why the concept of convexity becomes important. When you calculate the change in price, you also have to count for convexity. Convexity is a measure of the curvature of the price yield curve, like the curvature. This is the curvature. It's measured by convexity. The more curved the price yield relation is, the greater the convexity. The more curved the price yield relationship is, the greater the convexity. Straight line has a convexity of 0. The price yield curve were in fact a straight line. If the price yield curve were in fact a straight line, the convexity would be 0. The reason we care about convexity is that the more curved the price yield relationship is, the worse our duration-based estimate of bond price changes in response to change in yield, right? So the more the curvature, the less accurate our calculation. By combining duration and convexity, we can obtain a more accurate estimate of the percentage change in a bond in the price of a bond, especially for relatively large changes in yield. Okay, so you need to combine duration as well as convexity to get a more accurate bond price change. Especially if the interest rates move by a large percentage. Now, if interest rates move by a small percentage, the error is less, but if the percentage change is large, then there is a significant error. The formula for estimating a bond's price change based on its convexity and duration is given as follows. By the way, before we go there, now let's go back to the example that we just did, right? Now, in these examples, we assume that the duration figures given were Macaulay duration, right? And we calculated modified duration. Now, what we'll do is, let's assume that these figures given are modified duration. Okay, so let's assume these are modified duration and do our calculations again. For the exam, if it's not specifically mentioned, you can safely assume that the duration given is modified duration, right? So let's assume always duration given is modified duration. Like we use examples, we assume that it's Macaulay duration and calculated. So now let's assume that all duration figures are modified duration, not Macaulay. Right? By default, you will be given modified duration as exam. So let's work these examples again, assuming the duration figures are modified duration. Bond yield rise from 7 to 8%. Price falls 5%. You asked to calculate duration. That of course doesn't change. That will be the same. The modified duration is the same equation. This first question remains the same. Second question, if a bond has a duration, let's assume this duration is modified. Huh? Second question, modified duration is 5. And the yield increases from 7 to 8%. He asked to calculate the approximate change in the bond price. Minus percentage in bond price divided by change in yield is 1% increase, 1 plus 7%. Right. So what I wanted to explain is, if it's not specifically given, let's assume this modified duration. Okay. Right. Okay. So let's go back to the new question. It says the formula for estimating a bond's percentage price change based on its convexity and duration is percentage change in price. Okay, is negative modified duration into change in yield plus convexity into change in yield square. Let me take you back a couple of slides. and back into this one. Remember the duration calculation? Duration is negative percentage change in price divided by change in year 1 plus. If you isolate percentage change in price, you get minus duration into change in yield 1 plus yield. That's how you get this equation. Let's try this question. Consider an 8% treasury bond. Oh, by the way, there is one more thing. Right? At your level, you don't have to do the complicated calculation. You can just say duration minus percentage change in price divided by the change in yield. So the percentage change in price is equal to minus duration into the change in yield. Very simple. Okay, so this is the equation that you need to remember and apply. Now let's try this curiosity question. Consider an 8% treasury bond with the current market price of 908. Yield to maturity of 9. Calculate the percentage change in price for both 1% increase and 1% decrease in yield to maturity based on the duration of 9.42 and convexity of 68.33. Right, so let's try this question. This first scenario, 1% increase. So if interest rates go up, your percentage change should be negative. Let's see if we get a negative answer. This is minus modified duration is given as 9.42 into change in interest rates 1% plus convexity of 68.33 into it will be 1% spread. So if one yields it go up, your price will drop by 8.74%. Right? If not for convexity, the price would have dropped by 9.42%. So you are getting a bit of a cushion because of convexity in this case. So the next scenario is what happens if interest rates drop by 1%. Same equation, minus 9.42, change in interest rates 1% negative, plus well, this is not negative, has to be positive. Like minus 1% square becomes 1% square positive. So minus times minus, this is 9.42% plus so is that clear? Any questions? In second example, when interest rates go down, you have a positive duration effect, and convexity effect is anyway positive, always positive. So overall, you will see the price gaining by 10%. Then we go on to the risks in bonds, right? So investing in bonds are not risk-free. So many other risks involved. Even if you invest in a government bond, it doesn't mean it is risk-free, right? The only risk that a government bond can mitigate is default risk. That is also if a government has not issued a foreign currency bond, right? If it's a foreign currency bond issued by a government, then it's exposed to default risk. Okay, so let's go through these risks. Interest rate risk. Now, let's say you have purchased a 30-year bond at a rate of 10%, and all of a sudden interest rates go up. Right? So if that is the case, you will lose. There is an opportunity cost. Interest rate risk refers to the effect of changes in the prevailing market rate of interest on the bonds. When interest rates rise, bond values fall. This is the source of interest rate risk, which is approximated by a measure called duration. And so, as we learned just now, interest rate risk is measured by duration. Yield curve risk. Now, the yield curve also can change. It arises from the possibility of changes in the shape of the yield curve, which shows the relationship between bond yields and maturity. While duration is a useful measure of interest rate risk for equal changes in yield at every maturity, a parallel change in interest rate in the yield curve. Changes in the shape of the yield curve means that yields change by different amounts for bonds with different maturities. Now, there is nothing that says that when yield curves change across different tenors, change will be the same, right? So it doesn't mean that the 1-year bond and the 5-year bond will both move up by 1%. It doesn't happen that way. Maybe the 1-year bond might go up by 1%, 5-year bond might go up by 2%. There can be changes. It doesn't go up parallel, not always. Call risk. When interest rates come down, most corporates might prefer to refinance at a lower rate. So what they can do is they can call back whatever the bonds they have issued. Call risk arises from the fact that when interest rates fall, the callable bond investors' principal may be returned and must be reinvested at a new lower rate. Right. So reinvestment will happen at a lower rate. That's called call risk. Prepayment risk, again, when interest rates go down, the loans that we have given will get settled. That's called prepayment risk. Similar to call risk, prepayments are principal repayments in excess of those required on amortizing loans, such as residential mortgages. If rates fall, causing prepayments to increase, an investor must reinvest these prepayments at the new lower rate. Just as with call risk, an increase in interest rate volatility increases prepayment risk. Reinvestment risk refers to the fact that when market rates fall, the cash flows, which come from principal and coupon, for fixed income securities must be reinvested at lower rates, reducing the returns an investor will earn. Credit risk is the risk that creditworthiness of a fixed income securities issuer will deteriorate, increasing the required return and decreasing the securities value, right? So there can be default risk. Liquidity risk. If you buy a bond, you might not be able to sell it. That's called liquidity risk. It has to do with the risk that the sale of a fixed income security must be made at a price less than fair market value because of lack of liquidity for a particular issue. And so you might end up selling at a loss. Exchange rate risk. If you buy a bond denominated in a foreign currency, that also might lead to risks, because if the foreign currency one falls, then if the exchange rate goes down, you will lose, right? So for example, if you bought a US bond, if the exchange rate is at 195 and the exchange rate all of a sudden comes to 150, right? The value of your asset falls, called exchange rate risk. Inflation risk might be better described as unexpected inflation risk, and even more descriptively as purchasing power risk. This uncertainty about the amount of goods and services that the securities cash flow will purchase is referred to as inflation risk. Volatility risk is present for fixed income securities that have embedded options, such as call options, prepayment options, or put options. Changes in interest rate volatility affect the value of these options, and thus affect the values of securities with embedded options. Right? So there can be volatility in bonds. If you buy bonds, it doesn't mean that the bonds value will keep going up. It can go up, can come down, can move sideways. That's called volatility. It doesn't stay the same. Event risk, right? Sudden event like maybe a sovereign default, a tsunami, anything can happen. It encompasses the risk outside the risk of financial markets, such as the risk posed by natural disasters and corporate takeovers. Sovereign risk is essentially the credit risk of a sovereign bond issued by a country other than the investor's home country. Right? So if you invest in a foreign currency bond, there can be issues that foreign country might not have reserves to repay the loan. It's called sovereign risk. All right, so we come to the end of fixed income. Do you all have any questions? Any questions? No questions, let us move on. Let's move on to IFRS 9, right? Accounting standards. Now, when you purchase a bond, how do you classify it? What is your intention? Right? That is what is there under IFRS 9. What you plan to do with the bond? Right. The simplest case I can think of is take, for example, vehicles. Right? Vehicles. Now, if you're in the business of vehicles, buying and selling vehicles, if you have purchased a vehicle, right? You purchase a vehicle, your objective of buying this vehicle is to sell it. You have no other objective, only to sell. How do you classify it? Now, there can be other objectives also. You might buy this vehicle for personal use, right? So you might be in the vehicle business, but there might be a vehicle which you bought for personal use. Sometimes you might buy vehicles to sell. You have no other intention. You don't want to use it for now. You just want to sell it off, right? There can also be an objective where your intention is to use it for some time. You don't want to sell it right now. You use it for some time, and eventually you sell it, right? There can be all sorts of objectives. There can also be some objectives where you want to use it for now. It is a good antique. You want your kids also to use it. You want the entire generation to use it. You don't want anyone to change it, right? It might be the vehicle your grandfather used. Okay, so if that is the case, now we have various intentions. One might be to use it for a little while and then sell it. Maybe to use it for generations. Or perhaps you might want immediately sell it. So depending on these objectives, the way you're going to account for them should be different. Right? So that is what IFRS 9 says. When you do these accounting concepts, there are a few technical terms. The first one is a fair value. Fair value of an asset means what is the value you can expect by disposing an asset. Right? It's the estimated value of all assets and liabilities of an acquired company used to consolidate financial statements of both companies. Right? Fair value is used as a certainty of the market value of an asset or liability for which the market price cannot be determined, usually because there is no established market for the asset. Fair value is the amount at which the asset could be bought or sold in a current transaction between willing parties or transferred to an equivalent party other than a liquidation sale. So it's the price at which two parties are willing to go ahead with the transaction. It's called fair value. Now, before IFRS 9, standard was called IAS 39. Right? So it had four categories: fair value through profit or loss, available for sale, loans and receivables, and held to maturity. Right? IFRS 9 has three categories: fair value through profit or loss, fair value through other comprehensive income. Right. So there are two components of fair value through profit or loss, fair value through other comprehensive income. Third category is called held to maturity. Right. Under these three categories, you can classify the asset that you purchase depending on what your intention is. Right. So remember, it is based on your intention. Now, the thing is, when you purchase an asset, you have to then only decide what you're going to do with it. Subsequently, you can't decide. You can, but there can be penalties, right? So at the time of purchase, you should know what you're going to do with it. Have you purchased it to sell immediately, right? For trading, in other words, or have you purchased it to use for some time and then sell it off, or have you purchased it to use it for generations? You don't want to sell it off. No intention of selling. So what is your objective? That has to be clear. Now, under IAS 39, you all can read for additional reading. Good for your knowledge, but the focus is going to be IFRS 9. Right? Three categories: fair value through profit or loss, FVPL. That is the first category. Then the next one is fair value through other comprehensive income. Third category is held to maturity. Right? So this is FVTPL, FVOCI, and HTM, the three categories. Right? So depending on the classification, the treatment is also different. Now, the intention when it comes to classifying under FVTPL is to resell or to trade. Right? Your objective is to trade. You haven't bought it to use it. Right? Your objective is to sell. We need to trade. Trading maybe vehicles, you can trade bonds, or any asset you want. Then if you categorize under FVOCI, sorry, you got confused with present value and future value. This is not future value, it is fair value for the comprehensive income. To classify under FVOCI, the intention has to be sell at the right time. You don't want to sell it right now, but you sell it when the right time comes, not right now. Held to maturity, there is no intention to sell until maturity. No intention to sell until it matures. You hold on to it. But if it's a physical asset, it may be until it expires, right? Something like that. So depending on your intention, your classification can be different. Put it under 3 buckets. One of the 3, you can't put under all 3, right? But let's say this pen, I'm a trader in pens. If my intention is to sell the pen immediately, I will put it under FATPL. But if I want to use it right now, then someone else in the audience wants to buy the pen, maybe not today, next week, I can sell it. If the price is right, if I don't need it right now, I can sell it. But if my intention is to use this for ever and ever until I have to really dispose it, then it comes under HTM. Okay, the same applies for bonds. If you buy a bond, you should know what you're going to do with it. Is your intention to trade bonds? Do you want to keep it for some time and then sell if you feel the time is right or you need some money? Or are you going to keep it until it matures? Right, so that's the idea behind it. Depends on intention. Yeah. If you buy a bond for trading, there are fair value changes. Right. If it's categorized as FVTPL, it has to go under in the PNL. Fair value changes will get classified under PNL, recorded under the PNL. Value changes under OCI should get recorded in the OCI statement, other comprehensive income statement. Held to maturity, you don't recognize fair value changes. Then realized profits or losses, FATPL will go with the PNL. If the OCI bonds will go to PNL, and equity will go to OCI. Right? HTM you are not supposed to sell. So this is all you need to know. Depending on your classification, the treatment will be very different. Okay, so you need to remember this. Any questions on this? IAS 39 is not used anymore. IFRS 9 is the current standard. So what we need to know is that these standards keep evolving. Right? Accountants love to keep changing them, and we have to adjust accordingly. So these are the financial reporting standards in international. We have to abide by these. These are regulatory aspects. Right. I have given a small description on IAS 39. You don't have to read. unless you really want. Very interesting though. Right, so impairment is where you see an asset has dropped in value, then you have to impair it. Impairment can apply to all sorts of tangible as well as intangible assets. If there is evidence of impairment, you need to impair, and the carrying value of the asset needs to be reduced. Several identification methods. If there is physical damage, obsolescence, needs major overhaul, then it has to be impaired. All right, so we come to the end of that also. Any questions on this? Okay, so if there are no questions, I was actually I was planning to have a 4-hour session today. The next topic is on value at risk, right? So if we start it now, we might have to stop it halfway. Yeah, and then continue on Sunday, which is not ideal because it's better to either do the entire thing today or not do anything today. So since we've had a long day, I think we better take a break. We'll come back on Sunday and finish value at risk. And so let's not rush it today. So let's wind up for today, and we will meet again on Sunday, right, on the 28th, normal time, 3:30. So thank you very much. I hope you understood. I will see you again on Sunday at 3:30.